Hi, Felicia. Good morning.
Good morning, Stephen. How are you this morning?
Good, good. So I'm glad we had a chance to reconnect again. It's been like a month or more since our last, discussion. What I'd
hmm
like to do first is bring up our listeners and followers up to date on some of the videos we released in the past, and if they have any questions, how they can reach out to us. We did a lengthy discussion over the last couple of months on installment agreements, various types, from from a term of years to high net worth installment agreements to partial pay installment agreements to installment agreements for high net worth taxpayers over 100,000 in debt. So we actually talked about that for a long time in April, and there's a lot of issues and a lot of difficulty in getting the large installment agreements done now. Then we talked about one of your um, favorite issues, which is IRS losing taxpayer payments. And you talked about a six-figure payment that was lost and how you actually rectified that for your client, which was great work. And how if you have joint tax filers, you have to be very careful when you make the payments, or else you could run into that issue in the future. And then we had a nice discussion about Dodge and the IRS cutbacks of over 30%, which is actually apropos now, since we're actually in the midst of the third day of the government shutdown. And I've been told the IRS had money for 5 days.
hmm
And so we have 2 more days to go. And if that's not resolved, it's going to be very interesting next week. Very interesting in doing
Very.
business. So that was that was in the past. I want to just give a listeners of the agenda for the various blogs that we're going to be talking about today. We're going to be first talking about the various IRS notices that go out, what they mean, and which ones are more serious than the others, and how you respond to them. Secondly, we're going to be talking about New York State offers, one of my favorite things for sales taxes. It's a very big issue right now. Now we're going to go back to the IRS and talk about passport revocation. It's been a lot of passport revocations going on right now. I probably see at least once a week. You probably see the same. We'll talk about why the IRS does that and how we as practitioners respond to it. Going back and actually a related issue, we're going to be going back to New York and talking about New York State revoking driver's license, which is the similar motivation for the IRS revoking the passport and very similar procedures. And you could interject what you see on the state level for that. And then we're going to be talking about reasonable compensation, one of your favorite topics, and it's actually very important when a lot of people don't know what it is and how important it could be, and how much dollars they could be saving if they do that properly. And then we're going to finish up with IRS audit from start to inception. And at that point, we could go through any questions that either you have of me or I have of you. So let's get started. So let's talk about, for the next couple minutes, about notices. IRS has various notices that they send out um, when the taxpayer owes money. First will be the CP 501. Talk a little bit about that.
The CD 501 lets you know that there's a balance due um, on your return, and they're trying to get your attention, and it's a reminder before the IRS starts, a collection notice. It's the same as moving the next step would be, if you want to talk
So
about
it's
it, it's the CP
it's like a
504.
credit. It's like almost equivalent to a credit card company saying,
Yes,
"Hey, you missed a couple of payments. Just reminding you that you owe the money before this escalates any further." Very similar.
exactly. Exactly. It's just a simplified notice just saying, "Hey, we know you're out there. We know you owe us money and we're reaching out." It's kind of like a soft touch almost. This is
Yes,
we just want your attention.
right. I'm getting a lot of those. But let's now. talk about the next letter that I see, CP 504. That
CP
is
504
actually
is,
one of my
yeah,
favorites.
that's the one where they're starting to get serious.
Yes. And I get that, and taxpayers will panic because that it was a notice of intent to levy. But the
And
interesting thing is,
go ahead, I'm
it's
sorry.
notice of intent to levy, which
Right,
means it's not actually a levy.
that's correct. And so people get that confused, the word intent.
Correct.
Wording is words mean a lot of things to different people. And as we know today, most people only read certain words. And when they see those certain words, they get panicky and they're like, oh, they're going to take my money out of my bank account. And that's not what that notice is saying. They're saying, we will if you don't pay attention.
Right. Even though a lot of taxpayers get those notices, and in the notice it says the appeal rights for that one, even though it's not an actual levy. Do you appeal those, the CP 504?
I don't actually appeal a CP 504, but I do get with the client and say, let's start getting some resolution procedures set in place so that we don't go any further.
Some of my nervous clients actually want me to appeal those. It says the appeal rights. And the funny thing is, it'll give you the form to appeal, which is, I believe, the 9423.
Mm-hmm.
And I'll do it. And then coincidentally, a couple months later, the IRS will come back and say, Mr. Cass, we received your appeal. It's premature.
Exactly.
There's no
And that's
levy.
why I don't do it.
So, but I have clients that are really nervous when they see notice of intent. They go, Steve, can't let
Mm-hmm.
this ride. It says they give them, and then they get the form. They get the 9423 in the mail. It says fill this out and send it back. So someone that really wants to, I'll do it. But then I'll get the friendly mail from the IRS saying you've been premature.
So, and that's a good way to look at that. I mean, it's because it is premature. And if our clients would only understand that fee structure wise, it's better for them not to appeal it at that time because financially they can save that money for the bigger things that we know are coming
Right.
behind that notice.
But of course, they should be addressing the issue.
Absolutely.
They should have actually been addressing the issue when they got the first letter from the
They
IRS,
should have
which
addressed
is
the issue at the time that the taxes were
right,
due.
which
And
was contacting us and letting us do due diligence,
right,
running tax transcripts, putting them on like a questionnaire, doing an online evaluation to discuss what the ultimate end game will be, which is the offer installment agreement.
correct.
Now we're going to talk about letter 11. That one is a little bit more serious, isn't it?
Yes, that one says, hello, we are going to levy your bank account or whatever else they feel like they can attach to.
Or
Like,
seize property if they could.
yes.
Mostly bank
So,
accounts.
let's talk about season property for a minute. Do you see, or do you hear a lot of clients saying, oh, are they going to kick me out of my home? And the reality of it is they're not going to make you homeless.
Now, I've been in this business for a while. I don't want to age myself, but I've never seen a client getting kicked out of their home or apartment
But
but
they
they can.
will, they could, but that's not their objective. Their
No, that's not
objective is
objective is they
not
want to
to,
collect.
that's right. And so so I think it's more intuitive in the fact that if you have other property, other investment properties, they will and can make you sell that.
Yes, they can.
So
But the biggest thing is the bank accounts. Your money in the bank accounts, and if you don't respond to that the bank account is gone.
that's
After
it,
the
exactly. And once it's gone, there's getting it back is almost impossible.
yeah, if they actually levied it, I used to do a lot of bankruptcies back in the day when I had a boutique firm in Manhattan. You can actually file bankruptcy within 21 days and still try to recapture that back into what's called property of the estate. But you don't want to do that.
Yeah, but so that's the extreme of where you're
Yeah.
at.
I mean, if they come to us early, as we mentioned, when you got the first friendly letter, as opposed, and then the next one, we could have been ahead of the game and either put them on an installment agreement
Right.
or an offer. And once the offer is filed and are in the program, all collections stop and cease.
Correct.
But bottom line is, you get a letter 11, that's serious. You got to call someone. You can't, and I would actually call the day you get it. Give us time because we got to sit there and we got to front because it's easy to respond to the letter 11 and to file the appeal, but you need to put in an end game. What's the ultimate resolution?
Exactly. And that takes time.
Yes.
And that's the piece that the clients think that, oh, we just have this magic wand and we can just arbitrarily make it or look into a crystal ball. And we don't have that. We don't. And it takes due diligence from the taxpayer as well to say, I need to get all this information to you in order for you to be able to really fully do a good due diligence resolution
Correct.
review.
So let's move on. I think we've gone through the notices and the options and friendly the option from the beginning. Now I'm going to change focus to a state issue. I deal a lot with New York State issues, and one of my best clients lately have been New York State taxpayers that owe sales taxes. Now, sales taxes, this is when it could be from, which is very popular, a restaurant, like a restaurant in New York, Manhattan, Brooklyn, Long Island, that collected sales taxes. I've been getting a lot of restaurants, bars, clubs, bodegas that collected sales taxes during the COVID years, and they didn't have the money. They collected them, which they're required to, but they didn't remit it to the government. So New York State is even worse than the IRS, if you could believe that. Some people don't, but they are. Because I've been seeing sales tax debts could be 100,000 in 3 years with the interest and penalties that they accumulate. It's 200,000 in 5 years. It's 350,000.
And when you talk about it being New York State, it's also much more than just New York State, because most state entities, and I know even the state of Missouri, which is where I'm at, they really don't have a negotiating factor.
New York State actually does. They have a program which is similar to the IRS called Offers and Compromise. And it's very similar that you have to fill out the financial statement and give them docs. And New York State wants a lot of docs, more than the IRS. IRS will take 3 months bank statements. New York State wants 12 months. Every single account that you have. They want returns for the last couple of years. They want proof of your expenses to show you that you're in a distressed situation. And then they have one unique item that they only request that the IRS never does. They want a recent credit report within the last 30 days. And they're very stickler of that. If you file an offer and the credit report is older than 30 days, they're going to come back to you and say, give me a new credit report. I don't know. What I gather they want from that is to see if you have a lot of available credit that you could use to pay. But the bottom line is, I've been filing a lot of these post-COVID. Again, for restaurant clients, bodegas, sometimes transportation companies, and I've been getting really great deals for the clients that qualify. Getting, even though these are trust funds, which is the most serious type of taxes, I've been getting great deals. So the option is out there for New York. Again, that's the only state that I work besides the IRS. I mean, you may opine regarding other states, whether they have a program or not, but New York State does have that program. I do a lot of them. They work, and it's for a tax that if you don't address it, it's going to escalate and it's going to be with you for a while. New York State has a 20-year statute.
Oh, wow.
Yeah. So IRS has a 10-year, New York State 20. And after 20, could you imagine? I've seen a $100,000 debt after 20 years. You know what the numbers is looking like? Million.
I was going to say, yes.
Yeah.
That's crazy. I know that the state of Missouri has, you can do an installment agreement, right? But they only spread it out over 3 years. So
That's
that
right.
makes it almost impossible. Now we do have an offer program, but like New York, it requires a lot of paperwork, and it's not as simplistic as the IRS is. Realistically, it's a lot more detailed.
It is a lot more detailed. But for New York taxpayers, I've been doing a lot of them. I know the people there. I get them done, and I pre-screen the clients, making sure that I could get them into the program. It's a lot of paperwork. Sometimes the clients don't like to give all that, but the program works. So
That's the
let's
most
go back.
important. That's the most important statement,
Yeah,
Stephen. Is the program
yeah.
works?
If it didn't work, I wouldn't suggest it. Now let's go back to the IRS again. One thing that I've been saying a lot is passport revocations. You get a nice letter from the IRS to taxpayer. We see that you have seriously large amount of debt, and if you don't respond to this within 30 days, we're going to certify to the State Department to what's called revoke your passport, which means if you apply for a new passport, it will not be accepted. Occasionally, when I haven't seen this, but occasionally they can actually revoke a current passport. Besides,
It says that
yeah,
on the
yeah,
letter.
it says that on the letter. Now, talk to me about the dollar amounts. What dollar amounts will cause the IRS to issue this letter?
So if you have tax liability over $62,000, including penalties and interest, it can cause the IRS to send that they consider that seriously delinquent, and the IRS sends a certification to the State Department. The State Department then sends you out the notice that says we can revoke your passport and we can deny a current application.
Now, I've been getting a lot of these, and you want to know why the IRS is sending these? What's the motivation? I can tell you. They want the taxpayer to address the tax issues. They don't
Mhm.
necessarily want them to pay, even though they would like that. They want them to address it. And
It's
if
and
you
it's
address
an
it,
attention getter.
yeah, it is an attention getter. So clients come to me, they'll panic. But the good news is it's same services that we offer. They
Hmm.
want either the taxpayer to be on an installment agreement or an offer or to pay. So you
And
get
they
one
can
of these.
even be CNC. They can be currently non-collectible if, in fact, you can get that process
Yes,
passed.
I've done those too. That's the third option.
Hmm.
You either go in, you pay, actually four. You either pay it, which is, I mean, if the taxpayer had the money to pay it in full, they would have. So I usually don't get those clients, in fact, hardly ever. The next one would be going into installment agreement. You put them on a plan, one of the installment agreements that we talked about in a lot of detail a couple months ago. There's so many different type of installment agreements, but go on installment agreement, you're in compliance. Get into your offer program even before it's accepted. You're in compliance. Or if you're really distressed, no money or very
Hmm.
little money, talk to us about getting you uncollectible. Any one of those will stop this.
That's
And,
correct.
and even if they do revoke your passport, we can get it restored.
Absolutely. Absolutely.
And I do a
But
lot of those.
it's kind of like the intent to levy. Notice the LT11. Only it takes it one step further and says, we're not just going to take your money, but we're going to stop you from doing anything outside of the country. You're not traveling. You're not
You're not
leaving.
traveling.
You're not doing anything.
So I get these a lot where clients say, "Oh, Steve, I need to go on this business, major business trip, which I need to make money for my business. If I can't travel, I'm going to, lose the ability to work." Then they'll come to me, and I work, and I get it restored using one of the mechanisms that we discussed. Other issues, clients come, they go, "I have my daughter's getting married in the Caribbean. I'd like to go to the wedding."
Sure.
Yeah, and
Destination
yes,
weddings are a big one for those.
yeah. So now that's the passport. Coincidentally, New York State has their own little mechanism. You know what they do? Of course, they don't control your passport, but they do control something else: your ability to drive a vehicle. So, New York State, if you own more than 10,000, a lot lower amount, 10,000, they'll issue a notice of intent to suspend your driver's license, which means If you drive with a suspended license, now it's criminal, no longer civil. But the good news is the same thing as the passport. The state, New York State, wants you to address the issue, either installment, offer.
Mm-hmm.
They don't really have currently not collectible, but installment, offer, or even to dispute the amount if you believe the amount is, assessed in error. Now, talk to me. Do you see that in other states besides New York that go after your driver's license?
Yes, I do. I have seen it in the state of Missouri, which again is where I'm at, but I've also seen it in other states as well that clients have come to me and said, "Oh, look, they're going to take my driver's license." And I said, "Yes, because you're delinquent on your tax filings or you're delinquent on your paying." I just did a gentleman who we had literally for the state of Missouri had to go back to 2015 and file his return. So people think that, the IRS just asked for 6 years, but your state may ask for more than that based on what they're seeing. And then they can also, if you have liability, they're going to be looking at driver's license revocations, along, with if the IRS is pulling passports. And if the IRS is pulling a passport, the state may follow in conjunction with the driver's license too.
Yep, very serious stuff. But as I mentioned, good news, you come to us early. Second, you get the notice. We'll evaluate and decide either you're going to be an offer candidate, installment agreement, or something else, like either, disputing the money. IRS, again, has the currently not collectible. New York State does not have that. But I've been getting a lot of driver's license restored using getting the taxpayer in compliance. So as long as you come to us, this works.
And the key word there again, Stephen, as you keep repeating it, is getting you in compliance.
Right.
That's what they're looking for. They're looking for you to do something to
Yeah.
get yourself out of this mess that's already, and bad things happen to good people every day. And people need to understand that just because it happens to you doesn't make you a bad person.
No, but the government, IRS, New York State, other states just want to see, number one, that you're filing all your back returns, and two, that you have a plan. What is your plan?
Exactly.
As long as
And
you
what
have
is
a
it?
plan and you file your returns, you're good. None of these nasty things will happen.
Exactly.
Now, let's turn to one of your topics. I've seen you talk about it before. In fact, you did an online presentation with a group that we are in, and maybe even a live one in Orlando, about reasonable compensation and S corps. Very big.
It is a big topic. It is huge, and it's also an audit contingent with the IRS and S corps. S corps, C corps, some 990s even would fall into this particular avenue, but let's just keep it at the S corp, C corp level, mainly S corporations. And so, what is reasonable comp? Reasonable comp per the IRS says that you have to take a reasonable wage as an S corp shareholder owner based on what you do for that business. So if I had to go replace that myself, let's say myself, if I had to go replace myself, what would I have to pay somebody to do what I do? So in theory, that's the way it looks. But also, we want to look at that when we're looking at reasonable comp. The way we can calculate it is variable. So it's not always based on income. But what the IRS does say is if you are taking distributions out of the company as a distribution and you are not taking reasonable comp, you have a problem, because they will then flip your distributions, if you're audited, to reasonable compensation and penalize you for not doing due diligent payroll reporting and all of that falls in that line. So now you've just made a big Pandora's box even bigger.
Yeah, that's actually very scary now, and a lot of taxpayers don't know about this. Am I correct that there are services that that actually that you use and other that you could get taxpayers on that would actually for a fee handle that for them? And
Yes,
very
there is.
nominal fee, if I'm correct.
Yes. So it's not. So We do have programs that allow us to help the taxpayer or the shareholder owner to understand what their reasonable comp is supposed to be. And I walk through them, and I do these a lot with companies. Reasonable comp, it's figured, it's industry specific, it's based on your geographical location. And yes, it's nominal. I mean, for $500 a year, you have this done every year. We provide you with the minutes for your minute book, for your corporate book. So everything is in place properly, and you're
And
not
now,
guessing.
and if your experience in going through these, will will these survive an audit? With
Yes. So it will survive an audit. So here's how that works in the concept of you get audited and the auditor says, well, you didn't do reasonable comp. And you go, oh, wait a minute. And I pull out my reasonable comp report. And on that report, it gives everything they need to know along with the minutes. The IRS is going to accept that because if not, they have to go back and do their own, right? They don't want to do that. They don't want to take the time. They want to get the audit done and move it through and get the best results for both realistically. And so if you've got a reasonable comp in place and you've done that due diligence, the IRS is going to accept that reasonable comp report every day.
That's great. Well, I really recommend that clients that are in S corps contact one of us and discuss getting these reports done for them. Very nominal fee, and bottom line, it's almost like insurance. You do it, you follow the program, you're now audit proof.
Right. So you by prioritizing your compliance with the payroll tax laws and accurately reporting income as reasonable compensation, S corp owners safeguard both their businesses and their personal finances.
Great. And that is again very significant, and again, it's a topic that a lot of people don't know. If they have questions in S corp, they should reach out and talk to you because that's your
Absolutely. I'm here to help.
amazing. So let's finish up now with one of my favorites, audits. We were just talking about reasonable comp audits. Let's go over the whole audit process from start to inception. From a taxpayer will first get a notice from the IRS saying they've been selected for an audit. Now, these audits could be either by providing documents by mail, what I call the easiest type of audit, more serious, especially if you're a business owner or high net worth, they'll request either an in-person at their office or at your home or place of business. So in terms of these, would you ever recommend a client inviting the IRS into the home or place of business?
No, I would not.
Me
And
neither.
that to me is something that I have never done in my professional career. And I always recommend that I don't even recommend that the client go unless it is mandated by the IRS that they be there.
No, I mean, what I would do is I would go meet with the auditor when they really insist on it. I mean, I would prefer to do everything via mail and via telephone because again, they're getting the docs. But if it's a really intensive case with a business, they may want, instead of just submitting all these docs, they may want you to just bring everything to them.
And sometimes that's not always feasible. I mean, and that's one of the things that you have to negotiate with the agent. If the agent is not local and you're not local, so as you well know, as I do, we do clients that are not in our states. And
Yes.
so the audit is not feasible for us to travel there. And sometimes the IRS will say, well, the client needs to come in. Well, if I'm going to be the representative, then I'm going to be the one that needs to go in. And that may not always be the case. And so therefore we have to do things in the concept of virtual, whether it be upload tools or faxing or whatever that looks like.
Yeah. Again, that's my preferred method. I mean, I deal with a lot
Mine
of
too.
audits and I'd love to just, provide them. I love the upload tool, which they've done in the last couple of years, subsequent to COVID. It's actually really good for delivering high volume documents to the
Mm-hmm.
IRS securely. So you go through this process, whether it's in person, hopefully not, or via online and mail or fax, and you reach an impasse with the agent. It's still not the end of the world. you could actually request a conference with the audits manager. And if that doesn't work, there's an appeal process internally. Do you do a lot of those, both the audit manager and internal appeals?
I don't do a lot of them myself. I do some audits. I have one currently going on, but I don't have a lot of clients getting audited in my area right now.
Yeah, I do deal with a lot of audits, but usually I deal with audits for whatever reason. They come to me at the end when they've already gone through the process, where they've either had their accountant or themselves deal with the IRS agent, provide them docs in whatever format they have, and then the IRS agent, disallowed their expenses or found unreported income, and the taxpayer, claims that they were wrong. I've done a number of cases like that. They come to me and they're getting now a 90-day notice. That's
Hmm.
a pretty serious item, which means if you don't respond to that, and at that point, the only way to respond is to file a tax court petition, which I do. You file the tax court petition. It's actually not that difficult to file a tax court petition, but I only file them when I know there's an end game, where I looked at the taxpayer's proof and case and believe there's resolution. For example, a couple of tax court cases that I filed recently were clients that had like a work for a company and they were an employee, but whatever reason that they was like signing some docs, and the client was like an Amazon seller corporation, foreign corporation, and the 1089s got mistakenly issued to the taxpayer, millions of dollars. So simply thing is, I filed a tax court petition, provided the appeals agent that was assigned copies that this was in the corporate name. The corporation accounted for the money. They reported for it. It was reported to the individual in error, and we won zero tax, as
Sure.
opposed to a couple 100,000. Another one was a client that was, did a lot of what I call fantasy uh, football betting,
Mm.
and he would actually have gambling income and gambling losses. And when I say a lot, there was like hundreds of thousands of different activity. Again, I don't know anything about that because I don't partake in it. So at the end of the day, he said he was either zero or a loss. IRS saw just the income. They didn't, at that point, internal audit. They didn't accept any of his proof. I filed a tax court case. The appeals agent gave him the proof again in an organized format, resulted in zero tax due.
At that point, did you think that he's actually a professional gambler? So he's in the business of.
Um, yes. So yeah, again, he could have been, and that's a whole different issue in terms of tax compliance. But I won on that audit. Again, the trick is the audits. You deal the best you can internally. Best if the taxpayer does not respond to the agent, but hires a professional like you or me or someone else.
Hmm.
Because the ones that I mentioned, the taxpayer was giving the information himself. And whatever format they gave, it was not professional or the IRS didn't understand it. They continued the
Incomplete.
process and they went to the 90-day notice. If we were involved early in the process, same thing I did in tax court. Without having to go to tax court, could have been done.
Yeah,
So
sometimes
most of the
you
times I
audit
see,
reconsideration and get it resolved that way
right.
too.
So those, I see a lot of those. So again, the audit process, you get the first notice. You should respond to it. You should be hiring a professional. Don't do it yourself. Don't go to the field office. If they insist, have your professional do that. And then if all else fails, tax court is your option. And from my experience, the cases that I've been filed, I've been very successful, almost 100% winning on those. But let's say, for example, someone loses in tax court. Now you went through the audit, you went to tax court. Well, it's not all over at that point. you still got all the tools that we talked about before. You got the offer and compromise, assuming you qualify. You have the installment agreement. You have penalty abatement. There's a lot of tools to apply to deal with that tax, even if the taxpayer has lost in tax court.
And it's very good that you brought that up, because it's important for the taxpayer to know that if they did lose, they still need to come up with some kind of resolution to stop any type of collection activity.
Correct. And that's what we do. So I think, Felicia, we covered everything today. Do you have anything you want to add?
No, I think this has been great. I think this has been really good.
Okay, I'm going to just end this right now.